winning more when buying puts by avoiding this very simple mistake that I see a lot of traders make because they're just not aware of this concept, okay? And I talked about this for calls a few weeks ago, but today I want to talk about it for puts. Now remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. Now, let's first talk about puts here very quickly. So what I mean by puts here today is long puts or buying puts. So buying puts is a bearish strategy, and you want to implement it when you believe a stock will go down in price. That's what most people will tell you. However, as you will see here today, it's not as easy as the stock price just dropping. There's more to buying a put than just that. Okay, and so this leads me to kind of the main issue here that I see a lot. A lot of people I see nowadays are looking for stocks that have gone up, 50, 100, 200% in the past week. And they'll say, well, this stock needs to drop back down, right? Because stocks can't just go up 200% in a week and maintain those gains. It's going to have to eventually come back down. And so one example I want to use for today's video is NRGV, Energy Vault Holdings. So if you take a look at this stock, for example, in the last week, this stock is up almost 50%, right? So a lot of people will come, they'll see the stock is up 50%, and they'll just say, well, this has to drop back down in price. It can't, just go up 50% in a week and maintain those gains. And so what they'll do is they'll say, well, let me go ahead and buy a put, because as long as the stock drops in price, I'll make money by buying a put. And again, it's just not as simple as that, right? And so that's what I want to focus on here today, why it wouldn't be a good idea most of the time to buy a put on a stock like this that has gone up, 50, 100, 200% in 1 week. But again, I see a lot of people doing it, so that's why I want to talk about it here. So I'm going to be using this stock here, NRGV. Keep in mind, this is just an example. Now, before you go into the options, remember you should check two things. First thing is commission fees. So we're only going to be buying a put here. So that's one contract. Depending on what broker you're using, they may have high commission fees. It may eat away at a lot of your profit. Now, Robinhood doesn't have any commission fees, so we don't have to worry about it on here. Now, since we're buying options, we're not selling any options, there is no risk of assignment here, so you don't have to worry about early assignment with buying puts. So now that we've checked those two things, let's go into the options here, and let's discuss why it's not a good idea, again, when a stock has gone up this much in a week to buy a put and thinking that, as long as it drops, you're going to make money. So let's take a look here. Let's go into the options. And so very first thing I want to mention here for buying puts, you do not need to own 100 shares of the stock. You just need to have enough money to pay to purchase the contract, okay? Now, the first thing you do here usually is you go into the puts here, so let's switch to puts, and you'll choose a proper expiration date. So, I'm just going to leave it as the closest expiration date. That's usually what I see a lot of people do, again, because they're mostly trying to just make some quick money, right? Looking for stocks that have gone up a ton. Now they think, well, it has to come back down. It's going to drop in price. As long as it drops in price, I'll make money. So they'll go ahead and they'll come in here. They'll buy a put. They'll choose their expiration, and then they'll choose one of these contracts. So let's say that we want to buy this put here at the $20 strike. So as you can see, this is going to cost about $400. That's pretty expensive, right? For a stock that's this cheap, $20 per share. That's very expensive. So that should be something that kind of sticks out right away when purchasing this put. But they'll come in here and they'll buy this put regardless, and they'll pay, $395, $400, whatever it might be. And they'll go ahead and they'll place it. Now, here's where the issue comes in. The issue with these stocks that have gone up, 50, 100, 200% in such a short period of time is that they're going to have extremely high implied volatility. And a lot of people aren't aware of is that implied volatility does play into how much the pricing of an option is. So if I click on this option, and a lot of people aren't going to check this because they're probably not aware of this, right? We can actually see what the implied volatility is here. And if we take a look at implied volatility, it's extremely high. This is extremely high, 350%, guys. That is very, very high implied volatility. And the problem here, right, the problem is that IV does affect how much the value of this option is. Because if we take a look under the Greeks, there's a Greek called vega. And so for every 1% increase or decrease in implied volatility, the value of this option will increase or decrease by whatever vega is. So for example, if IV goes up 1% right now, the value of this option will go up by 0.01, or it'll go up by basically $1. Now, if the value of, or if implied volatility drops 1%, the value of this option will drop by vega. So it'll go down by about $1.23, right? So if implied volatility then, for example, drops 100%, the value of this option will drop by this times 100. Or in other words, the value of this contract will go down by $123. So implied volatility plays a role in how much this contract costs. And that's what happens a lot of the time. People will be, thinking, well, it ran up so much, now it's got to drop. And so I can make some quick money by buying a put. However, the market knows this, right? The market is aware that this stock has gone up a ton and that it's very volatile and that it's probably going to fall. And they price that into the options. So let's take a look here at on option strat to visually take a look at what could potentially happen and what happens most of the time when someone buys a put like this that has extremely high implied volatility. You should always use option strat before you place any trade so that you can visually take a look at what your trade will look like. And so if you use option strat before buying that put, you would see the risks involved. So let's go into here, let's go to build. And again, we're dealing with regular long puts here. So let's go to long put. And then we're using ticker symbol NRGV for today's example. So Energy Vault, we chose April 14th for our expiration. And then we said we were going to buy the put at the $20 strike. So this tells me this is worth about $435. Now, when it comes to buying puts, that's also going to be your max loss, right? So max loss is how much you paid. So 435. We have our max profit if this drops all the way down to $0. So here's what's going to happen. You might come in here and take a look and say, well, if on April 8th, right, what April 8th is right here. If on April 8th, this stock drops to $17, which is a 17% drop. That's a pretty big drop, by the way, that it has to drop. But let's say even if it does drop 17% by April 8th, you're going to come in here and say, well, according to this, I'll make about $84, right? And so, you'll be happy and you'll be like, yeah, it's a pretty nice profit, so let's go ahead and buy this put. However, again, implied volatility is extremely high. IV affects the pricing of the option. That's why there's a slider down here on the bottom right that allows you to see what's going to happen if IV changes. So maybe by April 8th, this stock will drop down 17%. It could, right, to $17. But it's also very likely that implied volatility is also going to drop along with it. And if IV even drops to like 200%, you're actually going to be red. So let's actually take a look here. So if IV drops to 200%, and by the way, 200% is still very high implied volatility. If it drops to 200%, right, now what's going to happen on April 8th, even if it drops down to $17, you're going to be down $56, right? So a lot of people are thinking, well, I'm going to make, $90 if it drops to 17 by April 8th. But then IV drops along with it, and what happens? Now you're actually in the red, right? And if it drops even more, like if it drops to like 150, you're going to be even more in the red, right? Now you're going to be down $90, as you can see here. And the more it drops, the more in the red you're going to be, right? If it drops to 100, now you're going to be down $123, right? So you go from thinking, I'm going to be up $84, almost $90 to, now you're down 100, almost $100 because IV dropped and you weren't aware that IV dropping affects the pricing of an option. And of course, IV going up also affects the pricing of an option. Now, if the stock makes a big enough drop, right, you can still be green here. For example, if it drops 24%, but that's a huge drop, right? Most people aren't expecting that huge drop. Most people are just expecting that, hey, if it drops, 12% or something, I'll still be in the green. But then after it drops 12%, IV collapses, and now, you're deep in the red here. And I see this happen a lot. So that's why buying put options here, when implied volatility is extremely high, is very risky. Because once IV comes back down, where you think you might be green, you actually end up very deep in the red. So always check implied volatility before you buy a put option. And of course, it's the same concept with calls, and I talked about that a few weeks ago. But anyways, as a general kind of note that you should always kind of keep in your mind, buy options with low implied volatility, sell options with high implied volatility, because when IV drops, when you're selling options, that actually benefits you. But here, when you're buying options, it's going to hurt you, as you can see here, right? So anyways, if you guys have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.